This is the typical experience of an amateur trader, a screen overwhelmed by neon lines, conflicting signals, and lagging indicators. But if you strip away the clutter, you are left with something far more revealing, a clean, minimalist line of price action. Observe the behavior here. While most retail traders are executing buy orders at the peak of a move, institutional participants are often doing the exact opposite. This gap between the two groups comes down to what they are actually looking at. To understand the professional perspective, we have to look at market structure. It is the raw footprint of every transaction, the foundational logic that determines the direction of the next move. Trading without identifying this underlying structure is identical to driving a fast car while staring only at the speedometer. You might know your current speed, but you have no idea if the road ahead actually leads to your destination or off a cliff. Price action is not a series of random fluctuations. It is a mechanical, readable framework built by the collective decisions of every participant in the market. Mastering this blueprint is the prerequisite for any successful strategy. Before you can predict where the market is going, you have to understand how it is built. Every market move exists in one of three states: trending upward, trending downward, or moving sideways in a flat range. In an uptrend, price steps up. We identify the peaks as higher highs and the pullback floors as higher lows. This pattern shows us that buyers are aggressively entering at higher price tiers. They are essentially refusing to let the price drop back to previous levels, forcing the market to find value at a higher cost. Conversely, a downtrend occurs when sellers are in control. They push the price into deeper troughs, creating lower lows, while the subsequent rallies fail to reach the previous peaks, resulting in lower highs. As long as this sequence of highs and lows remains intact, the trend is considered valid. By identifying these points, you ignore the temporary noise of individual candles and determine whether the objective bias of the market is bullish or bearish. Once you identify a trend, the focus shifts to timing. How can you determine if a pullback is actually over and the overarching trend is ready to resume? On this gold chart, price forms a higher low and aggressively surges upward, slicing through the previous higher high to create a break of structure. This confirms the buyers still have the volume to push the market further. A break of structure provides the structural permission to look for continuation entries. It confirms that the trend has successfully defended its territory. However, trends eventually fail. The market provides specific signatures that warn when a trend is losing its momentum. On the left, the trend continues. On the right, price fails to make a new higher high, dropping to break the previous higher low. This structural violation is a change of character. Here, institutions unwind positions, shifting momentum from bullish to bearish. A confirmed change of character signifies that the trend-following bias is no longer valid. It is the signal to prepare for a reversal. To see how this works in practice, let's look at a scenario that often catches retail traders off guard. Here, a trader sees a rapid spike in price and buys into the momentum, fearing they will miss the move. But they've ignored the fact that the broader structure just printed a bearish change of character. By chasing this breakout, they are buying directly into institutional sell orders. The candles might look bullish, but the underlying structure is already bearish. When you trade against the structural sequence, you are no longer relying on probability. You are simply hoping the market will ignore its own logic, a habit that consistently erodes capital over time. Market structure is not a guarantee of a specific outcome. It is a framework for managing probability. Even the most perfect structural setup can fail. Professionals use structure as a foundation. They layer it with other factors, like supply and demand zones, liquidity levels, and strict risk management protocols. Start by practicing on a demo account. Manually identify the highs, lows, and structural breaks on your charts until the patterns become second nature. Successful trading is not about predicting the future. It is about accurately interpreting what the market is doing right now. For more institutional-grade trading education and market analysis, subscribe to the Forex Alert. Understanding the market is the first step toward trading it.